What about cash, bank? They are what? They are what? Debentures, are they assets? Debentures, are they assets? They are what? Thank you. Long-term what? Right. What's a liability? Liability is what? Come again. Claims of outsiders on the assets of the business. Any outsider who can lay a claim on any of the assets of the business, that becomes what? A liability. So we have long-term liabilities and also what? Short-term liabilities. Assets are properties and resources that are owned by the organization, by the entity. So we have non-current assets and also what? Current assets. Then we have liabilities. Liabilities are what? Claims of outsiders on the assets of the business. Those we owe. Assets are resources that we, as an entity, belong to us. Master, the 5 minutes is up. Good. When the owner of the organization lay a claim on any of the assets of the organization, then that becomes what? A capital. A situation where we have asset equals capital. It means that all the assets of the company is being contributed by what? The owners of the company. But when we have assets equals to capital plus liability, it means that all the assets of the company are being contributed by both the owner of the company or the proprietor of the company and also what? Outsiders. So one of the equation is asset equals to what? Capital. The resources, the properties, the possessions of the organization, they've been contributed by only the shareholders or the owners, the proprietor of the firm. And in that instance, we say asset is equal to capital. But a situation where the asset of the company is being contributed or supported by the owner and also outsiders, then we say that what? Asset equals capital plus what? Liabilities. Projector. Yeah.
Paul. Yeah. And I open them to you.
Yeah. Continue. Yeah.
The situation where we have shareholders contributing to the company, the shares makes them part of the company or their asset becomes liability to the company.
Yeah, there's owners. Share of ownership.
Yeah. And a shareholder. And who is a shareholder?
Shareholder is someone who has partly or fully ownership of the particular.
The word is ownership. Ownership. Thank you. Ownership. Shareholders are the owners of the company. Stakeholders are not. They only have interest in the company. They are not owners. So that's the basic difference between a stakeholder and what? A shareholder. Yes. In terms of effect, good. Indirect effect. Okay. Okay, thank you. Yes. Are they part? Yes, they are part. Oh, Master, it's not coming up. This today, right? Okay. That's it. Go back. Okay. Yeah. Yeah. So, that. All right. Once again, we welcome all of us to ACT 501. Today we are looking at accounting system. Accounting system. When we say accounting system, what do we mean? What do we mean? We are just looking at the framework or the environments within which accountants or financial officers work. The accounting system. So we have what we call single entry accounting system and also double entry what? Accounting system. Then with a double entry, we have the cash basis of accounting system and also the accrual basis of what? Accounting system. We're going to take them one by one so that we can understand and appreciate the issues under each of them. Good. When we say single entry system, what do we mean? It says that the single entry system is a way of what? Documenting financial transactions in an organization. It's a way of documenting, recording financial transaction in an organization. And with this one, just one entry is made after each operation, which can be a debit or credit depending on the nature of what? The transaction. There are a number of transactions that take place in an organization. The last time we're looking at credit transactions or credit business activities, and also what? Cash business transactions or activities, and so on. We are saying that anytime there is a business activity, a business event, a business transaction, it must be recorded, it must be documented. And what is the purpose of documenting? Or the purpose of what? Recording business transactions and financial events. What is the purpose? Yes. Why do we have to document, record business events and business transactions, particularly the ones with monetary value? Yes. Thank you. Thank you. One is for the purpose of what? Referencing. Good. Any other? Come again. Accuracy. Thank you.
To be able to examine your business as to whether it's progressing or.
Thank you. To be able to examine your business. Know whether you are profiting or you are what? Making a loss. For what? Easy accountability. Thank you, online people. A single entry system is a simple approach that does not necessitate any special skill or knowledge. So once we are recording and documenting transactions and business events under the single entry system, we don't need any specialized skill in accounting to do that. We don't need any specialized professional in accounting to help us with our single entry. If you are into business, a sole proprietor, and we know a number of them, when you go to Makola, for example, they make millions and millions and millions of Ghana cedis. And they do their own recording. They do their own documentation and so on. And that one is what? The single entry system. You don't need any specialized skill or knowledge in accounting to do this recording. It is the oldest method of recording financial transaction. That is the single entry system. It goes on to say that with a single entry system, it appears to be what? Time saving. It is not laborious and cumbersome like the double entry system. And under this system, only few personal accounts are kept. Few personal accounts are kept. When it comes to issues of expenses and so on, most of the sole proprietors who keep this system of account, they do not keep records of expenses and other income. They do not. If they are paying for transportation and all that, they don't keep record of those expenses and so on. But when it comes to receiving of cash and so on, you see that they are so much keen on that. Good. The system is followed by a sole proprietor having total control on cash as well as on goods. So they only keep track of their cash inflows and cash outflows and so. However, this system is not generally followed by. It's not everybody that follows this. That's what it's saying. Now, the other aspect of accounting system is what we normally or generally refer to as what? The double entry system. Double. So we have the single entry system of accounting, where only one aspect of a transaction is recorded, documented, or is kept. The double entry is a system that is based on scientific principle and is used universally by most business world organizations. So this one, you will need a trained professional accountant to help you, to assist you do this particular one. This system recognizes the fact that every transaction has two aspects and records both aspects of each and every transaction. Every transaction, every business activity has two aspects. So with a double entry system, we need to recognize and record each of these aspects of transaction. That is what he's saying. It goes on to say that every business transaction involves exchange of equal values and benefits. One is giving and one is receiving. Exchange means the act of giving or receiving one thing in return of the other. It means that every transaction has two aspects. We have receiving and giving. And that's how life is. Life is about receiving and giving. There's one that is giving out, and there is one that is receiving. In this world, the women, they always receive. And the men are always giving. So in this class, we have the receivables and the payables. Or the givables, as somebody is saying. Receivables. So you see that the receiving aspect is known as the incoming aspect, which is debit, and the going aspect is known as the outgoing aspect, which is credit. So there's one debit and there's another credit. A double entry system bookkeeping approach is a system where each debit entry has a corresponding credit entry. And each credit entry has a corresponding debit entry. So there is one debit entry and also another corresponding credit entry. Double entry method of bookkeeping is complicated method that requires special skills and information. You need to be trained. You need to be trained. You must learn and be a professional. Then you can understand that this particular transaction is to be debited. This one is to be credited. Double entry system helps in the preparation of trial balance and financial statement of a business. If you want to prepare a financial statement at the end of the day, to know whether you are profiting or you are losing, there is the need for you to follow the double entry principle. So when you follow through at the end of the day, then you can prepare, you can extract your trial balance, and it's the trial balance that you use to prepare your financial statement. What are the components of a financial statement? It will come in the exams. What are the components of a financial statement? I'm stressing this one again. What are the components of a financial statement? Components. Yes, senior. Statement of profits and loss or statement of comprehensive income. That's one. Thank you. Statement of financial position. Thank you. You are there. Statement of changes in what? In equity. Statement of what? Cash flow. Good. In the public sector, we'll be looking at what? Income and what? Expenditure. Or revenue and what? Expenditure. Statement of revenue and expenditure. In the public sector again, we'll be looking at what? Receipt and what? Payment accounts. These things, know them. Good. So that's about the component of what? Financial state. So auditors come to audit you and they say, Director, we have come to do audit. Many a time, what happens here is this. When auditors come, they call the director, they call the accountant, and they call other management or key members of staff and say that we are coming to do audit. Bring your financial what? Statements. If accountant is not there and you are the director, you should know some of these things that the auditors are demanding for what? Statement of financial position, statement of receipt and payment, revenue and expenditure, and all these things. So when they bring them to you, then you will go through and say, oh, accountant, this one is not there. Where is it? And so on. Then they know that you too, you know. You have done MBA. So you know. Yes. The situation when the auditors come and they say, we are coming to audit. Then you call the accountant, your people are there. You go and see them. Then you are not a proper director. You are not a proper HR. Your people are there. Go and see them. And then when we go out for audit, and then a director, we say, Director, we have come to do audit. And then the director says, oh, let me call accountant for you. I say, Master, I'm not coming to audit accountant. You are the head of the entity. I'm coming to thank you and spending. You are the one signing. You are the one spending. I'm coming to audit you. It's not the accountant. Well, at the end of the day, if you are supposed to go to the public accounts committee, it is not the accountant that will be there. It's the head of the entity. We don't call accountant to a PAC. He's the head of the entity. Come and answer this one. So on. You should know these things. Good. Again, he says that under the double entry system, books of accounts can be maintained either by what? The cash basis. Listen very well. Either by the cash basis or what? The accrual basis. And when we say the cash basis of accounting, what do we mean? This one too will come in the exams. What do we mean? It's very important. This particular one, it will come because it's so dear to my heart. And you need to know this thing because most of you are in the public sector. When we say the cash basis of accounting, what do we mean? It says that under cash system of accounting, entries are made only what? What is there? Only when what? Cash is what? Received or paid. That is what he's saying. We only recognize, document, and record cash transactions. That's all he's saying. Under what? The cash basis system. No entry is made when amount is due for receipt or payment. We don't recognize, we don't record, we don't document any transaction that at the end of the day result in what? Receipts and payment, but cash has not been receipted or payment made or payment effected. What it means here is this. We have sold goods of 2,000 Ghana cedis to Kweku Menu on credit. At a very basic level in accounting, so far as the goods have left our premises and the client has taken ownership of the goods, we have earned income. It's on credit. We have earned income. But have you received the cash? No. In that instance, you don't have to record under the cash. Even though we have earned the revenue, but because we have not received the cash, we don't have to what? Recognize and record it. That's what he's saying. No entry is made when amount is due. So we have sold the goods. We have earned revenue. And the goods that we have sold is on credit. Have you received cash? No. So you need not recognize and record that particular transaction. Why? Because it does not involve the inflow of what? Cash. Oh, this space that we are operating, we are paying 10,000 Ghana cedis as rent for operating in this facility. The year has ended and we are preparing our account. The amount we are supposed to pay at the end of the year is 10,000. But then the actual cash that we are paid is 6,000. If we are preparing our account based on the cash basis system of accounting, we will only recognize the actual cash that we have paid. Even though we have incurred a cost of how much? 10,000. But the actual cash that we are paid, the actual cash payment is 6,000. So when you are preparing your account based on this principle, or based on this system, you only recognize and record what? 6,000. Oh, we have asked a painter to come and paint this place for us. And he's charging 5,000 cedis. At the end of the day, we have given him 3,000 cedis. How much are we owing him? How much are we owing him? 2,000. If you are preparing your financial statement at the end of the year, you can only recognize what? The 3,000 payment that you have. Even though we are owing him what? 2,000. Yes, Honorable. How will you treat uncredited checks? What is uncredited checks? Yes. What is uncredited check? You write a check to pay someone for the payment of what? Goods. One. Number two, someone writes a check to pay you. If, for example, you are owing me, and then you say, I'm owing you, how much am I owing? I say, oh, you are owing me 5,000. Then you write 5,000 check to pay me. When I collect that check, what happens? I will send it to what? To the bank. And say, Mr. what? Alassane, Siddiq. Siddiq is owing me, and Siddiq has written a check of what? 5,000 to pay me. Until, listen, no, until that check clears, and I can see the money gani in the account. If I'm preparing the financial statement, this one will not be what? Recognized. Hello, are you getting the whole argument? So that check that you are giving to me is yet to be credited to my account. It's yet to reflect in my account. Like just last week, they said they have paid our allowance. There's a special allowance that the university, they said they have paid that. That special allowance have been paid into our account. When was it paid? It was paid on what? Monday. Monday was, is it 14th or 15th? 14th, eh? And I've been expecting that money. So every day I will just check. No alert, but I'll check the account. I'll check. Then it was on Wednesday. When I checked, they say the money has landed, but it's hanging. Oh, how can some money land and it's still hanging? So on the platform, they say the money has landed, but in the bank is what? Hanging. My account is yet to be what? Credited. This morning, whilst I was coming here, I was still checking. The thing is still what? Hanging. So imagine I want to prepare financial statement right now. Have I received the cash? Is what? Hanging. Hanging what? Cash. I pray that by Monday it will drop. So that when I'm preparing the accounts, I will take that one word into consideration. All we are saying is that under the cash basis system, you recognize only transactions that involve what? Actual what? Cash inflows and what? Cash what? Outflows. Are we okay? So please, this thing, it will come in the exams. It goes on to say that this is an accounting system where transactions and events are recognized in the account only when cash, including cash equivalent, is received or paid by what? The entity. It goes on to say that income is recognized when money payment is made for a service, whether or not the associated benefit has been what? Received. All we are saying is that for the cash basis, we recognize and record only cash transaction, actual cash transaction. Good. Again, capital expenditure is not deferred, but is written off. You know what is capital expenditure? We'll look at it as we move on. What is capital expenditure? Come again. Depreciation. Almost there, but not there. What is capital expenditure? Expenditure, simply put, expenditures that you incur in acquiring what? In acquiring what? Assets, particularly what? Non-current assets. Good. So if you incur expenditure, you buy car, vehicle, for example. Vehicle is a non-current what? Asset. Motor van is a non-current asset. With a cash basis system, you don't keep records of what? Your assets and what? Your liability. You see that what? Capital expenditure is not deferred, but it's written off at the end of the year. The expenditure you incur on your capital assets, on your non-current assets, is written off in that particular period, in that particular year. That is why those days in the public service, headmasters and heads of department were stealing a lot. Because when they are about to go on retirement, they say, accountant, I'm going on retirement to anything for me. Accountant say, oh, don't worry. You see the bone shaker, you see the pickup there, I will write it off. You take it home. It will be happening, and we'll be catching them. The moment the headmaster is going, he takes the pickup home. An accountant will just write it off. Those days, when Ghana was applying this cash-based system, head of department will say, oh, I've worked 37 years in the public service, and I cannot go home raw like this. And you say, oh, but it was particularly for the vehicles, the pickups, and so on. So accountant, are you there? Yeah, accountant say, I'm there. What do we do? What are you? You must give me something. I'm going home. I'm going to die. So give me something. Yes. So they will team up. That's why you need to have very good relationship with your accountants and so on. So team up. Then you write it off. The one accountant is preparing a financial statement. Oh, the assets are there. So there's nothing like asset register under what? Under this particular system of accounting. Cash basis, there's nothing like asset register. All capital expenditures are written up. capital expenditures are written off. So you don't have anything to see. There's no trace of any of these non-current assets in the organization and so on. Hence, non-cash expenditures such as what? Consumption of capital or depreciation is not recognized. So you will not see it there. When you are preparing your financial statement, you won't see consumption of capital over there. In the public service, consumption of capital is the same as what? Depreciation. Accountants in the public service, are you there? Good. So you won't see anything like what? Depreciation or non-cash transactions in what? In the preparation of the cash system of accounting. Now, the next one is what? The accrual basis of accounting. It says that under this system, business transactions are recognized and recorded as and when it takes place, irrespective of the amount or cash received or paid. Irrespective of the amount of cash received or paid. Income earned as well as expenses incurred are recorded relating to what? A particular period. Income earned. The word there is what? Earned and incurred. This particular income, based on this particular standard or principle, have we earned the income? Yes. Have you received the cash? No. The principle says that still go ahead and recognize and record the transaction. We also go so much to this particular client. Has the person paid? No. But have you earned the income? Yes. It says go recognize it and record the transaction. Irrespective of whether cash is made or not. So far as you have earned the revenue, so far as you have what? Earned the revenue, you have transferred the ownership of the goods to the person, and the person has accepted liability. In that instance, this principle says you must recognize and record that particular transaction. That is what it's saying. The accrual word principle. And that is what we are currently using now in Ghana, particularly in the preparation of what? Our financial statement. The accrual basis recognizes transactions and events when they occur, which is backed by legally binding obligation to authenticate the transaction, and not necessarily when cash or its equivalent is received or paid. Again, it says that under this system, the transactions and events are recorded in accounting what record and recognized in what? The financial statement of the period in which the services are rendered or what? Received, rather than in the period in which cash is received or paid. With this one, it says that we can undertake a particular transaction and payment of that particular transaction is effected in future date. Under the cash basis, we only recognize cash when it is received or when it is paid. But with accrual, we recognize the transaction and record the transaction. If, number one, we earn the revenue, and then number two, we incur the expenditure. Those are the very important things we need to take away here. So what we are saying is that the takeaway point is that on the cash basis system, you only recognize and record cash transactions. Are we okay? What about the accrual system? What do you do? Hello, what do you do? We recognize the transaction irrespective of whether it is what? Paid in terms of cash or received in terms of cash. Are we okay? Good. So that is about accrual. Accrual. So all these are under accrual. Now let's look at the accounting principle under the double entry system. Accounting principles can be divided into two. The principles are some of the standards that guides in the preparation and the presentation of the financial statement. Financial statement. We have accounting principles that can be divided into two. We have the accounting concepts and accounting what? Conventions. Accounting concepts and also accounting what? Convention. Good. The term concept is used to connote accounting what? Postulates, accounting standards, and so on. That is necessary assumptions and conditions upon which accounting is what? Based. That is the concept, accounting concept. Then the term convention is used to signify customs. The word is what? Customs and traditions as a guide to the preparation of what? Accounting statement or financial what? Statement. Good. What are the accounting concepts? These are the accounting concepts. So the moment we mention accounting, so we have accounting principles. And under the accounting principles, we have the accounting concepts and also accounting what? Conventions. These are the concepts that we go by. Business entity concept, money measurement concept, cost concept, going concern concept, dual aspect what? Concept, realization concept, accounting period what? Concept. Good. Now, let's take them one by one. And under the conventions, we have the Convention of Consistency, Disclosure Convention, and also what? Conservatism what? Convention. These are the accounting conventions. Because of time, I'm just going to go through them. You know, we are supposed to take our week 3 lecture, but we are still on week 1 and 2. I don't know. So under the business entity concept, we are saying that the business is treated as a separate entity under the business entity concept. What it means is that the business is not a natural person, but the business is what? Is an artificial person. So whatever transaction that you undertake as a business entity must be different from the owner of the company. That's the business entity concept. So if the business is drinking water, it must be charged against the business. The business is different from what? The owners. Please, are you getting it? So whatever expenditure that is incurred on behalf of the business must be charged against the business. Whatever expenditure that the owner of the business also incurred must be charged against him. They are two separate things altogether. If the business is eating food, the expenditure in connection with that must be charged against the business. If it is rent, if it is transport, fuel, or whatsoever, it must be charged against what? Against the business. So if at the end of the year, you are using, let's assume that you are using your car for private purpose and also for what? Business purpose. At the end of the year, you have spent 10,000 cedis on fuel, repairs, and maintenance, and so on. You cannot charge the whole 10,000 to what? To the business, because thank you. You use the car, you pick your children from the house to school, and then you come back to business and all that. You cannot charge the whole amount to the business. The business will say, you are not fair to me. You are not fair to me. So you need to apportion it based on some parameters or some variables. You need to apportion it depending upon how you use what? The vehicle for family use and also what? For company use and so on. That's the business entity what? Concept. So the business is different from what? The owner under the business entity concept. That is what it's saying. So when you are preparing your financial statement, you need to take this into consideration. Please, are we okay? Then money measurement concept. We recognize and record transactions, only those transactions which are expressed in what? Monetary terms. Monetary terms. Those are the, so in accounting, this is also one of the very, very important word principles or concept, money measurement concept. So, in other words, a fact which cannot be expressed in monetary terms is not what? Recorded. So we don't record HR issues in what? Accounting. We don't do that. Moral values of the accountant, of the workers, we don't recognize and record them in monetary terms. Oh, this man, he has a very good moral life. Okay, what is the value of his moral life? 20,000? How do you value that? So all we are saying that we recognize transactions that are of what? Money value. Then cost, also very important. And the cost is saying that the transactions are entered in the books of account at the actual amount. Actual what? Amount. Those are the ones we recognize and record. So suppose a company purchases a vehicle for 50,000, but then the real amount in the market value is what? 55,000. But the amount of money that you have paid for the vehicle is what? 50,000. Which one will you record in the accounts? Which one will you record in the account? 50,000. That is what you have paid for under the cost concept. That's what we are saying. You don't say, oh, but this vehicle is costing 100,000 in the market. So when auditors come, they are looking at what? The documents that shows that, oh, you have paid this amount for this particular vehicle or this particular asset and so on. So that's about cost concept. Then there's this one called the going concern word concept. Are you seeing all the concepts? These are the, and accountants use it a lot to bully those of us who are not accountants. So you need to understand them. So the next time they are mentioning them, you can talk. Going concern is perceived that the business will exist in a foreseeable world, future. Going concept. Going concern concept. Nobody enters into a business to make losses. True or yes? Yes. Nobody is born into this world to die. We all want to live and live forever. But whatever happens, one day you die. This concept is saying that the moment you establish a business, you have the idea, the motive is that the business will continue to exist in the foreseeable world future. So when you are preparing your financial statement, the financial statement must be based on this particular word, principle. Unless you say that, oh, by next year, this business will die. And for that matter, if you are going to prepare your financial statement, it must be based on which principle? Who can tell me? No. Going concern is where we are saying that you have the mind that the business will continue to exist in the foreseeable future. Just like you and your wife. You have that particular concept that We will continue to live for each other until what? Death do us what? That is the going concern. What is the opposite of the going concern? Huh? What's the opposite of the going concern? You said something. The going concern. We are saying that accountants prepare their financial statement based on the going concern, that the business, the organization will continue to exist forever in the foreseeable future. That's how the accountant prepare their financial statement. But if they realize that, oh, this company can no longer exist in the foreseeable future. Why? Because of certain things. And it happens a lot. Like, for example, in 2017, when some of these banks, like the UT Bank, the Unibank, GM Bank, and the rest, when their licenses were revoked, remember, how many of you were there at that time? 2017, 2016, yes, when their licenses were revoked, and their accountants, and you know, in that 2016, it means that in 2017, there's no way you'll be operating. Are you okay? So if you're an accountant there and you want to prepare your financial statement, the financial statement will not be based on this principle. It will rather be based on the principle we call the breakup basis or the breakup principle. Just like you and your wife, you are now breaking up. They say, my wife, because you are stubborn, I'm breaking up with you. Or the woman will say, most of the time, it's the women that will file for what? Divorce, breakup. Yeah, most of the times. You see that this man is cheating. You go and collect sickness and bring it to me. No. I want to leave the marriage. They want to break up. Most of the time, it's the women that will want to break up. Yes. But how about the men? Oh, they day inside. Yes. Day inside. The women, they don't cheat. They always blame us for cheating. So when it comes to break up, it's the women. All we are saying is that if you cannot continue to exist, like in the case of the banks, where we know that their licenses have been revoked. So in the foreseeable future, they will no longer be what? Be existing. If you are the accountant there and you are preparing financial statement, the financial statement must be prepared based on the breakup basis and not on the going concern basis. Come again. Liquidation. So we can talk about liquidation. You are liquidating. In this case, so all we are saying is that normally the accountant, when they are preparing their financial statement, particularly statement of what? Financial position. We say you have your assets. So when you have your assets, you have the cost of the asset, accumulated depreciation, and the carrying amount or the net book value. So when they are preparing their financial statement, based on the going concern concept, this is how they go about it. The cost is there, accumulated depreciation, they take it from the cost, then they get their net book value or the carrying amount to the following year. But then, let's assume that the cost of the asset is 10,000, accumulated depreciation is 8,000, then the carrying amount is 2,000. Please, are we getting it? Now, the carrying amount being 2,000. With the going concern concept, this is how it goes. But if it's going to be on the breakup basis, let's assume that the asset is motor van, and we want to prepare the account based on the breakup basis. In that instance, in that sense, we are not going to prepare the accounts using this particular model, but rather we'll go to the market. Now we want to break up, we want to stop, we want to liquidate. The organization is no longer going to what? Exist in foreseeable future. So you go to the market and you want to find out this particular vehicle, because we are breaking up. We are breaking up. This particular vehicle, if you want to sell it today, what will be the value? What will be the amount that we realize from the sale of this particular asset or vehicle? Oh, it is what? 3,000. So when you are preparing your financial statement, you are going to look at the actual market values of those what assets, and not by this. Hello, are you getting the whole argument? Yes. You will not consider anything like depreciation. If you are preparing a financial statement based on the breakup basis, you are not going to look at the depreciation. What are you depreciating? You are only looking at the current actual market value of the asset. Please, are you getting it? So whatever cost that you incur in bringing the asset to its condition and location will also form part and parcel of what? The cost of the asset. That is what we are saying. Then the revenue is the expenditure for the purpose of either trade or business. So any cost you incur in administration, distribution, and maintaining the assets, the non-current, like repairs and maintenance and all that, will be captured in what? In the profit or loss account. So repairs and maintenance, now we are using the asset and we are incurring repairs and maintenance costs. And that will form part of the revenue expenditure. The cost of the asset itself will be a capital expenditure. And that will be captured in the statement of financial position. But the revenue expenditures are captured in the statement of financial, a statement of what? Comprehensive income. Yes, sir. Come again. Yes, he's asking a very good question. If you are registering the vehicle that you are acquiring, good. Will it be a capital, will it form part of the capital expenditure or revenue expenditure? Will it form part of the capital expenditure or revenue expenditure? We have to test it. We are seeing that whatever expenditure that you incur, the expenditure, before it can be part of the capital expenditure, it must be connected or related to the asset, in a sense that it must be a cost that we incur in bringing the asset to its location and condition for use. Are you okay? Its location and condition for use. So let's take the question is asking. The registration of a vehicle for a business. Registration for a vehicle for a business. Now, if you don't register the vehicle, can you use it? Can you use it? That is in the private sector. In the public sector, there are vehicles that are there. Some of them are not even having insurance. And then yet we are using them. And government say, yes, for now, we should not insure any government vehicle. Or is there any government vehicle that is insured? Have you seen any government vehicle that is insured? Oh, are you not having, some of you have even brought your government vehicles here. Is it insured? Huh? Why? And here you are using it. So at times it depends. Why? It's not insured. And yet you are using the vehicle. Why? Who can tell me? You have not insured the vehicle. And you are using it. How many of you know Barredo? Yes. Come again. Whether comprehensive or third party. Insurance be insurance. Insurance be what? Insurance. How many of you know Barredo? Called you Barredo, yes. How many of you know Kojo Baredu? Former what? Former finance minister. You know, before then, government was spending so much on insurance. So imagine government vehicles for all the public sector institutions, ministries, departments, and agencies. We are going to insure all these vehicles. And we are insuring these vehicles, giving the money to the private world insurance companies. The money these people were making from government vehicles, not a joke. So when Baredu came, he says, no. Even when he became the finance minister, Baredu said, no way. How can we be spending so much? Millions of Ghana cedis on what? Insurance. So from today, no insurance for any government vehicle. If government vehicle knocks an individual, we will assume what? The risk. So if you take government vehicle, not you, if you take government vehicle to knock somebody, they say government should assume that particular risk. So whatever cost it is, it's better for us to assume that cost, incur that cost, than every year how many government vehicles get accidents. Come again. You are individual. Government say you don't have money to be paid, so you insure your own. Are you getting the whole? It makes sense. Or it makes sense. Even now, so since that is what I'm saying for individual, but not for government vehicles, because but can you take government to court and say that government, you have not, even that one, if you take government to court, that government, you have not insured your vehicle. Senior, you take government to court, that government, you have not insured your vehicle. All we are saying is that government is also looking at what? They make the laws. The laws are there to help all of us. But they're also looking at it that no, how can we spend so much and be paying for this insurance to the insurance companies? No. So if government vehicle is involved in an accident or whatsoever, it's better for us to incur a cost in fixing it rather than what? Every year insuring. No, we won't do that. And I think it's a very good decision. Now look at this. State whether each of the following items should be classified as capital or revenue expenditure. Purchase of leasehold premises. Is it capital or revenue expenditure? Capital or revenue expenditure. Lawyers' fees in connection with the purchase of leasehold premises. Good. Annual depreciation charge for the use of the premise. Depreciation charge or consumption of is what? Revenue. Good. The next one is what? Hey, today you are not making my thing to flow. Senior. It has gone off. It's my problem. Serious. I was thinking you have the listener. Don't you have?
How much like
But it's a slide there. I'm not sure. Yes. So payment for rent and rates, is it capital expenditure or revenue expenditure? Capital or revenue? So payment for transport, is it revenue? Aha! Is it transport of what? I like that. So you are transporting equipment from the supplier's end to your premises. Is it capital or revenue expenditure? So transport, you are conveying the material or the equipment to your premises. Carriage what? Carriage inwards. The cost incurred. So in that sense, it is what? In that sense, is what? Capital expense. Repairs and maintenance of machinery. Repairs and maintenance. Is it revenue or capital expenditure? Revenue. Salaries and wages. Is it a revenue or capital expenditure? Good. So you should know these things. It will come in the exams. All right. Today we'll close at 6.
Apply the machinery,
Mm.
then you employ the services of an expert to take you through the operations of the machine. That kind of expense is going to be capital or revenue expenditure.
Good. So it's a very good question our friend is asking. Very good question. Yes, please ask so that they will answer you. Mm-hmm. Okay. Good. You apply the services of an expert. Yeah, we are listening. Senior. Uh-huh. Mm. Do you get this question? Very good question. Uh-huh. Yes. Is it going to capital or revenue expenditure? Huh? Is it capital or revenue? It's capital. It's capital. So if you engage a professional, in this case, we are talking about a lawyer. Lawyer's fee in connection with the purchase of a land. But this one is in connection with what? An equipment. Yes. So whatever cost that you incur, whatever you pay for professional work services will be connected and related to the capital expenditure item. Salaries and wages, they are revenue or expenditures.
Maybe assets acquired by the organization and shows that help to improve the earnings
No,
of the organization.
not improve. We are saying that you are bringing the assets to its location and what condition for use. And senior is saying that for us to be able to use this particular, okay, you are not okay, okay, okay. So capital expenditure, okay, with what Hajia is also saying, if you incur a cost, a significant cost in improving the assets, that's number one. And as a result of the improvement in the asset is going to bring in more future economic benefit, or the production capacity of the asset will be enhanced. In that sense, it will be what? That particular cost will be what? A capital expenditure. Are you okay? Yes. If you are going to, the cost of the asset or the cost of the improvement is such that at the end of the day, the capacity of the facility will be enhanced, then you need to add that to what? The cost of the assets. Yes. No, it cannot be. So every year. Then that one is different from maintenance, so repairs and maintenance. But what he's talking about is where you in taxation, there's something we call repairs and improvement. Are you okay? In taxation, we call it repairs and improvement. If the cost is to improve upon the assets so that the productive capacity of the asset can also be what? Improved. That becomes a capital expenditure. But if you are just incurring the expenditure for the purpose of maintaining the capacity of the asset, in that sense, it is not what? A capital expenditure. Good. If you buy a software, at the end of the day, if the productive capacity of the asset is enhanced, that becomes a capital what? Expenditure. Okay. That becomes a capital. So far as you are engaging professionals before the use of the item or the asset, that becomes what? A capital expenditure. Irrespective of the time. Before you can use the asset, you need to know. Do you get? Yeah. Hello. Hello. Yes. I remember. Yeah, saying what?
So that we can get the correct verdict.
If you can do it.
You can repeat the correct answer. And when you ask questions.
Okay, the answer. All right, that's fine. Yes. I remember in 2015, was it 2015 or 2014 that we started this validation? Yes, sir. 5 minutes. No, you make it 15 minutes. You add 0 to it. It was in 2015 or 2014 thereabout when we started this validation in the public service. Before salaries are what? Paid. You need to what? Validate. Oh, this particular employee is at post. Approve, 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 approve. Then controller will what? Pay. We spent millions of Ghana cedis in purchasing that particular software and getting what? Consultants on board to train all government what? Employee, particularly the HRs, on how to use that particular software. And the cost of the purchase of the software and the cost of training by these consultants were all capitalized. Hello, are you okay? Subsequently, government engage, almost every year, people go on what? Retirement, people leave and all that, and you need to get new people on board and all that. So government engage some other private people to be doing the training for those who are new in the system. And when you look at the controller and accountant general statement, that particular cost that they incur in training these people, the new people now, is captured as what? A revenue expenditure in the controller accountant. Is that your question? Good. So that is it. So subsequently, whatever cost that we incur in retraining the people will be regarded as what? Revenue expenditure. So that's it. Cost of installing new machinery, repairs and maintenance, and all that. That's why some of us don't like this IT, internet, because it's delaying our work. Clarification of accounts, 15 minutes. Accounts in the name of persons are called what? Personal account. So these are the type of accounts. Then accounts in the name of assets are known as what? Real accounts. So you should know personal accounts and what? Real accounts. Accounts in respect of expenses and incomes are known as what? Nominal accounts. Good. Then when you say personal account, these are examples. So we have Mr. So, and this one. These are examples of personal accounts. Then real accounts, accounts that you can see, tangible. Real accounts. And tangible and intangible. Real accounts are impersonal, which are tangible and intangible. So we have cash and also what? Goodwill. These are all real. Then nominal accounts. Nominal. They exist in what? In name, but not in nature. They are salaries and rent and all these are nominal accounts. They exist in name, but in nature, they don't. Then this is one of the basic principles that we'll be using when we come to the practical issues in accounting. Debit and credit. Debit the receiver and credit what? The giver. Good. Thank you. So we are now coming to start today's lectures. Today is what? Week what? Week 3. Week 3, we are now coming to start today's lectures. It's about recording of what? Business transaction. Yeah, it will come in the exams. So these are the objectives. Maza, come and take this one also so that you go through and then because of time, my big man says, Maza, pack and go.
Prof will come and
Is it Prof will come and yes, I know. So is he around? Okay, you come after 10:30. But is your snack is ready? So you want to go for snack? But you don't like me. Huh? You love me. No, you love the food more than me. All right. Yes, those who have not registered. Those who have not registered. Where are they? Yes. They say I should introduce myself to you. Who is this man? Yes. Let me see those who are fresh here. Those who are new, raise your hand. Let me see.